Hello and welcome to Personal Finance. I'm Kukuletu Cele. Now, tax may be the last thing on a couple's mind when they're planning their future together, but it begs the question as to whether marriage is a penalty or a bonus in this instance. Piet Nel, Project Director at the South African Institute of Chartered Accountants, joins us now for more. A benefit or a, what is it, bonus or something?
A bonus or a penalty.
Exactly.
Yeah.
Maybe let's get into that a bit, especially when it comes to the marriage contract. So I take it firstly you need to establish whether or not you and your partner are in a union for a significant period of time.
Yes, you must. The tax legislation, and we talk income tax, state duty, etc., looks at whether you're married in community of property, where you don't really, there you basically agree up front, everything is going to be shared equally. You then, the second one is where you sign a contract before, that's the antenuptial contract, where you spell out the assets that the partners have at the beginning of the marriage, and whether or not the growth, or what we call the accrual, in the marriage will accrue to them in individual portions or to the separate partners individually. Now, if you enter into a union, then it's normally not reduced to writing, and I think that is a problem. You have to convince SARS to get some of the tax benefits. There are benefits, and I recognize that when you marry that there must be some benefits, or when you live in a permanent relationship. So SARS wants you to be able to prove that that union is intended to be permanent when it's entered into. And it's often really advisable to reduce that to writing. So I think for two reasons. The one is that the partners then understand what they're actually entering into, and secondly, later it's difficult to call up what the exact agreement was if you didn't really have one.
Exactly,
Yeah.
Especially when things go wrong.
Go wrong, yeah. That's
But
right.
let's touch on that. So number one, you need to notify SARS and also to establish what kind of union that you have.
Yeah, it's not necessary to upfront notify SARS. It's merely to keep those records. SARS is on a system where you don't send, they don't lose the documents, but they don't want to keep the documents. They're not a filing system. So it's when the matter is necessary for them to adjudicate on that they want that. So one would have to retain those records. And it's definitely then necessary when you either the marriage is dissolved or when there's death, because then it also is important. Yeah.
We'll get to death in a moment or two. But what about income on investments? Is that also a certain play?
Okay, let's just reduce the income on investments. You principally would either get rental income or interest income or dividend income. I think those are the three common things that people would invest in. We'll talk about capital gains, I'm sure, later. So you would, from an income tax point of view, any interest that accrues to you would be basically subject to tax, gross income, but there's certain exemptions. We spoke about the tax-free investment accounts where the income would not be subject to tax. So there are concessions there. Dividends tax is withheld from the company that makes out the payment. And then there's no normal other tax consequences that follow from that. So you pay your 15% and that's final. You don't have to worry about the tax consequences after that. Rental or any trade income that you enter into is like a partnership. So if you have agreed that we will share it, I'm contributing an equal amount to what you're contributing into the investment, then the income should be shared equally. Otherwise, you reduce it to the agreement, and that income is in tax in the individual's hands as normal income.
We know that we're heading up to the budget speech later on this month. Are we expecting any surprise announcements from the Davis Tax Committee with regard to this?
Not with joint investments. I didn't have a brief to actually, they did have a brief to look at the tax mix. Okay. And we're expecting that there may be some surprises in that the minister certainly has to make the budget balance, and I don't know where he's going to get all the money from, so that we'll see towards the end of the month. But the Davis Commission didn't have a brief to talk to that apart from the tax mix. And we've already in 1994, if I remember correctly, had said that we're no longer taxing spouses together. In the past, the income was added together. Now it no longer is added together. So
tell us about the risks involved in that, because certainly some people might have thought if you move your income to the partner who had the lower income bracket group, then there would be benefits for the both of you there.
Yeah, I think that's an important concept, because a lot of people are saying there's no donations tax, for instance, so I can donate assets to my spouse and move assets freely from a tax point of view. There's also no capital gain, so I'm disposing of an asset and there's no capital gain. So they seem to think that there's no tax. But SARS recognizes, and they've recognized this years ago, probably 50, 60 years ago when the Act was written. They said, if you move, because you would be inclined to move it to the lower tax-paying spouse. So
I would.
Yeah, so that you're paying tax at 40%, you want to make an investment, so well, if I make it jointly, 50% of the interest would accrue to my spouse, and she would not pay any taxes or would hardly pay any tax. There is an anti-avoidance measure that deems that income to be mine. So the law is very clear that if you do this, and it's specific, two specific reasons, there must be some gratuity involved, so donation or settlement that they refer to. and the sole purpose must be avoid tax. So a taxpayer has been successful in a court case where over years he'd contributed to a pension fund, and then finally when he retired he said, let's split this pension 50-50, put 50% in my spouse's name because she allowed me to work, she looked after the kids so I could concentrate on my work and build up quite a nice nest egg. And then SARS wanted to tax that and wanted to apply that, and he said, I never had tax evasion in my mind, and he was successful. But those are the two rules.
So the key issue here is avoidance when it comes to donations.
Yeah. So if your main purpose of doing this is because I'm wanting to make use of the lower tax rate, then then there's a big risk.
What about suspicious kind of assets or suspicious kind of donations? If basically one spouse has other business that they do on the side that might not be 100% legal, if that kind of transaction surely gets donated to the other spouse, then are there some...
That would be the same. I mean, yeah, then the moment that SARS can prove that there was tax avoidance intended in what you've done, I mean, I wouldn't want to comment on if it's absolutely illegal what you're doing, then of course the tax consequences should follow that part. But if it's done and there's no tax evasion in mind and the income is adequately declared, then it's no problem moving it between the spouses, and as long as that sole purpose is not to avoid taxes there.
Fantastic. Capital gains was the important one that you touched on. I think there's a lot of confusion with regard to that. Maybe if we can highlight which assets firstly would fall under that kind of classification.
Yeah, and again, we're not talking about, so when we married in community of property, we jointly own the property. And then you're basically just moving your 50% to your spouse, but then you get 50%, so it's not there. It's where you're not married in community of property. And then, as I've said, the Act recognizes spouses as customary marriages or religious tenants, or where you can prove that the intention was to have it permanent. Then the principle is sound. It says if you move assets between spouses, there's no capital gain. So, but the risk of that is that when the second spouse disposes of that the capital gain will then arise and will be bigger. So let's say I've got 100 Rand now, and I move it to my spouse when it's worth 300 Rand. Then I actually make a capital gain, but because of what we call rollover in the capital gains, it's not taxed now. So her cost doesn't increase to 300 Rand. But when she sells it for 500 Rand, they will tax her on 400 Rand. And again, they'll ask, now, why did you move that there? Was it to get it into a lower tax rate? And if the answer is yes, the sole purpose was to make use of a tax benefit, to have a tax avoidance, then they will take part of that profit back to me and tax that. So you are entitled to freely move assets between the spouses, as long as you don't have that sole intention to avoid taxes.
So again, looking at the transaction there and what the key purpose is.
What the purpose of that was, yeah.
But if we jointly own a property, then let's maybe move it to that way. Now we're disposing an asset to an outside party with the CGT, then kick in at that point?
It would, yeah. So the moment you sell, and let's just deal with that jointly earned. So jointly earned would mean that there is some agreement, because we're not married, so we don't have an anti-nuptial contract to deal with it, accrual or anything. So we say, if we haven't got a drawn-up contract to say this will happen transactions, we will, with each such transaction, have to come to some agreement, and I would reduce that to writing. So I'll say we're going in here 50-50, or either 60-40, depending on the money that we both put in, or the effort that we put into this thing. And then the capital gain will then be shared in that ratio that we've agreed on. So when we dispose of a property that's worth 100 Rand, and we've got a 50-50 arrangement, each of us will declare 50 Rand, and we'll declare the costs that we have as a deduction, and the balance is our capital gain. Yeah, so the moment it goes out, let's just call it that family unit, then the tax will be levied on that asset.
If you both are this married couple or a couple in a union which is recognized for the long term, does this also apply to maybe your dependents like children? No, it's only between the spouses. So we've been lobbying for that, and in fact maybe the Davis Commission will make some comment about that. I mean, there are rumors that we want to abolish estate duty, and one of the reasons is that you often leave your family there. If you don't leave it to the spouse, you leave it to the children,
and they then pick up a tax liability, and that principle should be extended to that, we believe. So yeah, SAICA believes that maybe that would be a good idea to say let it flow through to the children as well.
That's something that's still in progress. And
it is still those are proposals that were made, and the Davis Commission will be, I don't think their report definitely is not out on that yet. So yeah.
Let's move on to estate planning, because that's another one that you touched on, maybe a very important one. because that's usually when the problems set in.
That's right.
Does this also go back to the kind of union that you have and what you've set out in your marriage contract?
Exactly right. So as we say, for all the tax acts, there's one definition of what a spouse is. So it's either in community of property or with an antenuptial contract, or in the tenets of religion or your customary marriages, and then that last one where that was intended to be permanent. And exactly there, the executor will not know this. So you will have to, when you draw up your will, say, add to that a document to say, listen, we are in a union that is intended to be permanent, so that the person's dealing with that, it may be an independent person that doesn't know the family, that he or she knows that this person has intended this assets to go and that they were actually sort of spouses in the tax context. And the benefit then is again that there's no estate duty. So when you pass assets on from the first dying to the surviving spouse, there's no estate duty.
If there was to be estate duty, how much would it be charged at?
Estate duty is levied on a net value of an estate. So that would be the market value of assets at the date of death, less your liabilities and debts that you owe to people, of 3.5 million plus. Now, if you're married, that actually goes up to 7 million. So you can pass on to the surviving spouse if you haven't used your 3.5 million rand, you can pass it on to her. So the last dying spouse can up to 7 million rand not pay tax, and the tax in is at 20%. So it is significant. It's similar to the nation's tax, but it's easy to plan around that.
That's a huge saving, and maybe people don't often recognize the consequences or the saving that or the benefit that it could have. Does this need to be stated out in a will and testament, or does it happen when the state handles the deceased estate?
Well, if you die without a will, so where we say if you die intestate, so you haven't got a will, then the surviving spouse will get and it depends on the number of children. You get a child share plus a share, a minimum 135,000 rand at the moment. So you get a basic amount. So the estate is sort of divided on the basis of the number of dependents and spouses that are left, and those assets that move over to surviving spouse will go tax free. But if it's below 3.5 million rand, typically there will be no tax on death. But the principle is there. So any asset that goes to the surviving spouse, that would not attract any estate duty.
Give us a few takeaway points. We've in the last 10 seconds of the show. The viewers need a few takeaway points. Clearly understand the type of marriage contract that you're in. That's the beginning step.
Yeah, and reduce to writing and be clear and upfront when you make investments, so that both parties understand whether this is a joint investment and understand the tax consequences. And I would think get advice before you make the investment. So.
Exactly. Piet, thank you so much for your time. Sounds to me like there are more benefits than penalties involved when it comes to getting married and tax benefits.
From the tax side only.
Exactly, from a tax side only. But as Piet said, it's imperative that you get some advice there. But that's where we leave it for Personal Finance this evening. Thanks once more to Piet Nel, Project Director at the South African Institute of Chartered Accountants. Remember that we want your feedback and give us your particular situations that we're in, and maybe we can apply it. You can tweet any of your comments or suggestions to @CNBC Africa using the hashtag Finance410 or to myself @Kukumfupi. Until next time, it's goodbye for now.